Well, good morning, everyone. Welcome to Trading Index Options. My name is Barbara Armstrong. I am a coach with Schwab. Today, you will not be enjoying the dulcet tones of Mr. Ben Watson. He's helping his daughter move today. So I have the privilege of stepping in for him, and I'm delighted to do so. Ben and I talked yesterday afternoon about what he's been doing in this class. And so I am really excited to be filling in for him. And we're going to talk about how in this crazy environment we're currently trying to live profitably within from a trading perspective. How might a trader embrace index options and trade them in a way that is higher probability? And that's what he's been talking to you about. And given how much things have changed day to day, and we only have to look at the S&P 500 for the last week to see how wild the changes can be from day to day, how can we position ourselves that even if the wildness continues, that we still have an opportunity to be profitable. So that's what's on the menu for today. We have Cameron May with us in the chat. And so if you are not following Ben, Cameron, and I, you are missing out in the world of X. So my handle at Barb Armstrong CS, Ben's is at Ben Watson CS, and Cameron's is at Cameron May CS. So you may want to put that on your to-do list if you aren't already doing that. I know that some people prefer not to be on X. That is our way of being able to communicate with you outside of webcasts like this. So I encourage you to take advantage of that. I only use X for my trading life and, for my Schwab life, if you will. So you don't have to, choose to participate in the whole world of Twitter. You can just participate in the Schwab coaching world, and I think you'll find it worth your while if that's what you'd like to do. No saying that you can't, follow anyone that you're interested in hearing things from, but that's how I'm using it. In any event, just before we get into the thick of things today, know that everything we discuss here is for general information purposes only, should not be considered an individual recommendation or a personalized investment strategy. Know that past performance doesn't guarantee future results, and know that equity and index options carry a high level of risk and aren't suitable for all investors. So we have to take that into account. And when we're trading options and this plan that we're going to discuss today, we're looking at options that are near expiration. You've got to consider the risk specific to a strategy like that, which could include lack of liquidity, price slippage, and volatility, and things can turn on a dime. And you can have a nice gain and it can turn into a nice loss pretty quickly, or vice versa. So we need to be aware of these things. Okay. And we're looking at a lot of technical analysis today, but that is not to be construed as an endorsement of technical analysis as your sole means of investment research. Okay. We're using the Paper Money software application, and that is, I think, such a brilliant place to learn. Okay, so let's come out to the Thinkorswim platform, and when we look at the S&P 500, we've seen a lot of pain since we hit this all-time market high on February 19th, right? In fact, at one point, I guess I have to draw my line the other way, down 20% in a pretty short period of time. And even from where we are today, we're down 13%. So for an index that, had an extraordinary year last year, a lot of that, has been given back if an investor had continued to be invested bullishly in an index like this. So, what do we do with this? Well, one, if we look at the trend, how would we characterize the short-term trend and the intermediate-term trend? Well, if we're playing, I Spy with my little eye, which is really what technical analysis is all about. From the 19th of February, we had a downtrend, tried to recover. That looks a lot like a bear flag to me. Came down again, so new low, lower high, precipitous fall, and then this kind of whipsaw back up, but still, we are looking at still, even with this, a lower high. And then the last 2 days kind of pulling back. And so, can we take advantage of this trend? And when I spoke with Ben yesterday, he said the general rule of thumb is we're going to be bearish if the S&P 500 is below the S&P, below the 200-day moving average. And, it's basically been below the 200-day moving average since March 7th. And it came up and kind of played a little kiss and tell here, but it turned out not to be a breakout. It was a fake out. And in fact, we've been below the 30-day moving average since February 24th. And we've spent most of our time below even the 10, even though we're above the 10 now after this extraordinary day on Friday. And this index down another 1% today. Somebody's asking what the arrows mean, the green and red arrows. I talked about a simple example trading plan a couple of weeks ago, and I put those on my chart. A red arrow means, and I have this on the 30-day moving average, which is red. A red arrow means that this index has crossed and closed below the 30-day moving average. And if the arrow is green, it means it's crossed and closed above the 30-day moving average. Okay. So that's what those arrows mean. There was a question in the first class this morning that Kevin Horner and Brent Morris did, to open the trading day. It's like their candle was green, even though we were down on the day. And they asked why. And I use something called candle trend, which not only looks at the movement of a candle, but puts it in the context of where it is trading or where it closed relative to the day before. So you can see here that on this day when we hit a recent low, that we opened low, closed higher than where we opened, but still closed below the low of the day before. So the white in the box means that we closed higher than where we opened, but the red indicates that it was still a down day. And on this one, the dark green means, we opened higher and then retrenched a bit, but still, and closed lower, but still closed above the day before. Now, and this is just a personal preference. So if I go to appearance and change this to just candle, you will see that this looks like a red. This is expressed as a down day because, in fact, it did open higher and close lower. But that kind of drives me nuts. It's like, hey, we were up on the day. Why is, this a red candle? It should be a green candle. And likewise, why is this a green candle? I think it should be a red candle because it closed lower. And that's just kind of the way my mind works and the way I prefer to see it. But you can do whatever you like. You have a choice. And like today, this is showing that we're up. This candle is currently trading above where it opened, and yet it's down almost 1%. And so I use candle trend. And so if you're wondering, how to change your chart or why sometimes charts look a little different, if you go to appearance, you can kind of play with this. And see. And if you want a different background, so one of the things that some traders will do is they'll have one background for paper money and a different background for their live account, so that, when they go to place a trade, if they think they're practicing and then they see that, the background is black or the background is gray, they're going, ooh, that's my live account. You know, so it's just a reminder for you. Okay, so let's look at the S&P 500 now. What some people might choose to do with an index is say, hey, you know, it looks like a bear flag. We have, you know, here was our high day, or it could be this, but if we look at this as our high day, you know, we are now trading below the low of the high day, which would be considered an entry. So just let me, and I'm sure, like, you know, we have so many of the usual suspects here, you know, hello to Riceberg and Carol and High Speed, Low Drag and Skylo and the rest of the gang. If you are new here, please type a greeting into the chat so we can welcome you. If you are trading a flag type pattern, one of the things that some traders may have on their trading plan is that they are looking for a close below the low of the high day. Some people will call that a cablode, you know, and it's just kind of an acronym or a nickname, you know. And so some traders might say, well, if I want to trade verticals, as in short verticals, this is downtrending. So I'd look at a short call vertical somewhere above this, maybe 5,500-ish mark. Let me change my drawing tool. So could we sell something above the 5,500? So if we come out to the trade tab, and if we look at this 5,500, we have a delta of 29 on that. What Ben has said is, let's look at a new trading plan for index options, and let's look at something that is a 15 delta. So what do I mean when I say that? So let's come here, and I'm going to add probability of in the money and probability of touching to this. So what the delta of 30 is indicating here, and this is just kind of a rule of thumb, because what delta really means is if this index goes up by $1, the value of this will go up by 30 cents. But what this is telling us is we have a 28% probability currently of this being in the money 15 days from now, and a 55% chance of it touching. And he's saying, yeah, I say nay to that. We're going to come out to a 15 delta. So we're going to cut that amount of risk basically in half. And now we have a 14% chance of it being in the money, which means we have an 86% chance of it expiring worthless, and only a 28% chance of it even coming up and kissing that. And why are we looking at 15 days? Well, let's say we're, you know, and this goes back to, you know, what are your goals? You know, why are you even doing this? You're not just showing up because you're trying to kill time. One would expect that you're either trying to protect your giant heap, build a giant heap, or generate income, grow the account. So let's say you're trying to grow your account or generate some income. And so the idea here is that we're going to go out 15 days, and next week, wherever we are with this trade, we are going to buy it back and then sell another one. And so we're going to come here, we're going to sell a vertical. Oh, we aren't going to do the 5,500. We're going to come out here to this 15 delta. And we can see here, we've got about a 70-cent spread on a $17 option. So it, you know, the bid-ask spreads are very tight. You know, the SPX, very heavily traded here. And this is a cash settled index. And it's important that we notice when these things settle. And we can talk about that in a moment. Oh, I'm coming back to the 29 again. Okay, let's scroll down. So in here, like a 60-cent spread, we're going to sell our vertical. And we're getting paid $1.70 for this, and we're risking how much? $10 less. Well, it's now $1.85. So if we look at this and we say, well, is the juice worth the squeeze? Well, if I can make $1.75 and I'm risking $8.25, my potential return on risk is about 20% for a trade I'm only planning on being in for 7 days. Okay. So if we look at this and we say, well, let's look at this account size. And this I had, put privacy on. This is one of the things I like with Thinkorswim is that you don't have to make your account balance if you were in a live account visible. But if we say, hey, we're willing to risk up to $2,500 and we're risking 800 if I come to confirm and send, 825. So if I did 3 of these, I'd be risking $2,500. Now, are we hoping to lose 2,500? No, we're in this to make money. But if the trade goes wrong, we don't want to blow up our account. And so we're going to be very disciplined about how much risk we're taking. Okay, so we're going to come back here. We're going to do 3 contracts. And, could we put an exit in and say, hey, if we've got 80% of our max gain, we'd like to buy it back? We could do that. And if the market really drops dramatically in the next couple of days, which it could do, then we could end up not even being in this a week. This is a short vertical. Yeah. Yeah. So we're going to come to single order, first trigger sequence. We're going to right click and create an opposite order. And this again is personal preference. Some might say, I'm not going to do these, that I watch these like a hawk. And so, I'm just going to, I'm just going to monitor it myself. I like to take advantage of sometimes volatility in the morning. And sometimes if something moves down dramatically and then rallies like it did a few days ago, I could be out before I'm even, it could hit my target in the first couple of minutes that the market is open and I could be out of that position. And so that's why I like to put an exit in. But again, that's a personal preference. And you might say, well, why did you pick 80%? I just picked 80% as, as an example. You might want to pick 90%. You might want to pick 50%. You can pick whatever you want. And so I don't think I have a category here called, oh, here we go. Oh, well, that's ETFs we want. We're just going to call this indexes. So I'll create a group for this. But we've got this teed up. And then a week from now, so next week, we would go in, and if it hasn't hit our 80%, what are we going to do? We're going to close it out. And so what we may want to do is create a group. So we're going to come here now that we're in this, move it to a group, and we're going to add a group, and we're going to call our group, and call it whatever makes sense to you. Index short verticals. Now, if you're not familiar with short verticals, we can, you can go to Getting Started with Options, and there is a class on short verticals. Okay, so I am going to customize this because I want to see where I am from a profit and loss percentage. I'm going to put that in there. And if this is something you really trade heavily, now this is right at the very bottom. So when you come in and look at your positions daily, so you may, want to just scroll down to the bottom, or you could move this right up to the tippy top of your groups so that you know what you're looking at. Okay. Okay. So that's the SPX. And if we wanted to put our strikes on the chart, we can come out here and our strikes are at 5,600. So I can take this line, and we want it to be above 54.58. So if I edit this, this is going to be 5,600. And then I can say here's our short call vertical at 5,600, 5610. So when I come and I look at the SPX, and if this is a strategy that you are trading regularly, you know, you may just leave this line on the chart and then just, you know, change it on a weekly basis. And you know that, you know, you're always just going 2 weeks out. And then you're closing and placing a new trade, you know, every week. Now, I don't normally teach this, so I don't have a trade to close out, but if I get to fill in for Ben again next week, we'll close this trade out and then open a new trade. And so, you know, when we look at this, you know, if you're not familiar with this strategy, the idea of a short call vertical is that you are selling a call. Now, when you sell a call, what are you agreeing to do? You're agreeing to sell the underlying. Now, this isn't a stock, it's an index, which is cash traded. But if this was a stock, it's saying, I'm willing to sell you 100 shares of this stock at 5,600. If you want, I'm happy to sell it to you. But we don't have any shares of this. And we don't, you know, if we have a small account, like it may be out of our snack bracket, you know. So what we do is we come out here and we buy a call, which gives us the right to buy the underlying. And the idea here is that our expectation, given the trend of, you know, this particular index, and given that it's come up here and we now have our close below the low of the high day. And if we look at resistance levels or ceilings, we could look at this as one ceiling and then the 30-day moving average as another ceiling. So I kind of look at it as lines of reinforcement. I see knights in my head, you know, medieval knights. And I've got a row here. And then if you get past this moat and you know, I've got a backup group here. So as long as this stays below here for the next week, if it goes sideways, happy camper. If it continues to fall, happy camper. You know, and if it falls, you know, this gives us a higher probability of making our money faster. Now, why only 14 days? Why 14 days? It's because when you get under 21 days, so when you're less than 21 days to expiration, time decay speeds up. It's accelerated. And so we are looking to, you know, sell something and get paid, you know, in our case, say it was $1.80. And then what we want to do is a week from now, we want to buy it back for less. You know, if we could buy it back for 36 cents, we'd be happy campers. But if we can buy it back for 90 cents, we've got half our max gain. You know, so we're looking to sell it for more, buy it back for less. And as long as it stays below here, and this is why these are somewhat more forgiving trades, because they're less directional. So if it goes down, we have a successful trade. If it goes sideways, we have a successful trade. And, you know, our strike is at 5,600. So, you know, we have what, 250 points worth of wiggle room. It can even go up a little bit and we'd still be okay, as long as it stays below 5,600. Now, what is the other thing that affects this price? It is volatility, my friends. And so when we look at volatility, when do we want to sell? Well, volatility tends to pump the prices up. So if volatility is high, that's a beautiful thing. You know, and then what we'd like to do is sell when it's high and then see volatility go down, because then it takes some of the value out of our trade. And so if we come and look at volatility, and volatility tends to have an inverse relation to price. And it's interesting because today, and this is not a ton of movement for this index, like we've seen some extraordinary moves, and it's still at the very high end of the range. This is a 6-month chart. But if I go out for the last year, I mean, we've only had, 2 or 3 days in the last year where it was basically where it's trading now. So volatility, if we look at, the longer term, at almost 30, it's still high, even though it is down, 2% today. And that's unusual for volatility to be falling and the market to be falling at the same time. Now, somebody asked, why are we selling calls and not selling puts? Well, we're doing a short call vertical because we're bearish. That's the reason. When we come to this, we had this long-term uptrend, which, now has been compromised, and it's broken below, this level, and then broke below the 200-day moving average. And then the 200-day moving average looks like it's now acting as a ceiling. And the 30-day moving average looks like it's acting as an area of resistance. So we're just trying to go with the flow of the market. Yeah. So the other thing I wanted to point out on the trade tab is that, we can customize this, and I had probability of in the money and probability of touching up for a purpose, but we could bring our Greeks up and, delta, gamma, theta, and vega. So we can see, when we've got 2 weeks to go, we have so many strikes up here because we're going so far out of the money, but our theta, it is $1.89 and $2 because we're only 2 weeks to go. Now let's come out and look at an option that's further out. So $2, keep that in your head. Let's go 28 days out. And we'll come back to this same 15 delta. $1.24 and 69. So at $1.24, was it the 5,600? $1.91. So, our theta is working at an accelerated rate. And that will continue to go up. So if we come and look at something that's now 7 days out, and we're looking at the 5,600. And I'm sorry there's so much scrolling, but we're just so far out of the money here, kind of a necessary evil. So when we look at this 5,600 strike, $1.32 is our theta. And, we've got 7 days to go. Now, when we start getting out further, but, our 15 delta is 267. So the closer you get to expiration, the more accelerated your time decay. And this is why some people prefer short options. Now, if we're doing this with the S&P 500, would we want to do this also with the NASDAQ? Well, let's go and look at that. So similar looking chart, right? It's below the 200-day moving average. It's below the 30. We've got this series of bear flags. We still had from this high or from this high, we're still looking at a lower high. We're still looking at lower lows. So, if we look at this and we say, okay, let's look at this same concept. We're going to come out to our trade tab, and we're going to look at something 15 days to expiration. And we want a delta of 15. Now, do you notice a difference here? 67.20 versus 73.70. We still have a lot being traded here, but when we look at our bid-ask spread, it's much, much wider, which lends me to question, what's our open interest and volume like? When we get to these far out of the money, we've got very little volume. So that could mean that it might be difficult or more difficult for us to exit that position. And you've got, a $5 bid-ask spread. It's still less than 10%, but you've just got far less liquidity here. And so this is why, for this type of strategy, some people stick with an index like the SPX. Now, could we come and look at the Russell also? Sure. And if we come out to this 15 days and we come out to, a delta of 15, so we are scrolling way, way down. One contract. No contracts. So and some might say, well, hey, this still, has a bid-ask spread of only 40 cents. So, you might want to play with this in your paper money and just see. So let's come and look at the chart. So here's the Russell, pretty similar looking chart again. And, if we look at where our 15 delta is, 1985, if we draw that on our chart, that's right where the 30-day moving average is. It hasn't crossed the 30-day moving average since the middle of February. So let's do one just as an example. Brett, Ben isn't here, right? Yeah. So let's look at this. We'll do our 16. We've got a 15 and a 14 delta. And let's just see if we can get enough premium for it to be worth our while. So we get 80 cents on a $5 wide spread. So, that's, a little less premium. Now to go apples to apples, 85 to 95, $1.55 or $1.50. So we're risking $8.50 to make $1.50. So $1.50 divided by $8.50. So that's a 17% return for a trade we'd be in for 7 days. And if we're okay with that, we'd say, okay, we can do 3 of these. And we put it in the same way. And, does this mean we're staying do or die? No, your trading plan for this might say, unless I get 80% of my max gain, next Wednesday, a week from now, I am exiting this position. And why might you choose to exit a week before? Because you have very little time to recover if anything, kind of goes against you. And so we're going to put this in, we know it's at the very bottom, our short verticals. What does the percentage place in the 52-week range mean? So this year to date it means that year to date, the Russell is down 15%. So far this month, it's down 6.6. And this week, it's up 1%, which is how we formed our little bear flag. Okay. So this is year to date, month to date, week to date. And I have the script for that in the post pinned to the top of my Twitter feed. Laura is asking, what about changing the dates, like Ben, one for 7 days and the other for 14 days? When I talked to Ben, he had said that he was focusing on placing trades 14 days out, and then closing them the following week. But, you could do a trade with 7 days to expiration. You're going to have accelerated time decay, but if we have a day like we had Friday, then there's very, very little time, to recover. But, with where our strikes are with this one, which is still working, oh, they only want to give us, well, they're saying 155. We'll give it a few minutes, but it's a 1985 is where our strikes are. So if we just draw a line and then edit that, I don't worry about getting that close because I'm going to come in and fine tune it. So short call vertical 1985, 1995, and this one has a May 1st expiration. So you can put whatever you want on there. And I have my default set to be a dotted line that's blue and a little thicker so you can see it. And I've saved that as my default. I also like to see the price on the right. The default is for it not to show. Okay. So Chuck is asking if we ever do same day trades, not deliberately. That isn't the plan, but on occasion in trading a smaller account where, we may have, let's say, put on a conditional order here and said, hey, if this index falls below here, we would like to buy a put. And if we had a 1 ATR target, we could have ended up in that trade at the beginning of the day and out by the end of the day. But that wasn't the plan per se. The plan is just to be in it for a short period of time. Now, in trading a smaller account, would we be doing these? Chances are no, because of, we don't want to risk more than $500 on any one trade. But, could we do, if you have a smaller account, you're saying, I don't want to risk $500 or I don't want to risk $800, let alone $2,500. So the dollar range for our smaller account, we start the year with 20 to 25,000. This year we started with 25,000. So, but could we do this and say, hey, we're risking $415, and that is our guideline in that class is we don't want to risk more than 500. So we would do one contract. And you might say $80, like that's not all that in a bag of chips. Well, no, but you know what? If you can do that consistently, and one of the things that I talked about, and I did a little recording on this, so let me digress for a moment, because if you are not subscribed to the Trader Talks channel, you're going to want to hit the subscribe button. It's another free resource for you to be able to take advantage of, but especially, and not only if you're young, but I recorded this thing on the power of compounding. And it's in the, so go to playlist and then come down to trade management mini sessions. The color is aqua. And I've got 2 short videos on the power of compounding. And this idea of how $5 a day invested over time can grow. And I looked at the S&P 500 and NASDAQ over the last 50 years. And I said, if you took $5 a day, over the last 30 years and just invested it on a monthly basis, like just had it go to an account and let that grow, I think in 47 years, you'd have something like $4.4 million. And so if you haven't watched this, I encourage you to check it out. And if you find it interesting, like, watch the second one, because somebody had said like, oh, you made a mistake. And so I wanted to correct it. It was like this idea of paying yourself on a monthly basis or on a bi-weekly basis, as opposed to just saving the money up and then putting in 1,600 or whatever it turned out to be, in December of the year. First of all, when you have that amount of money and it's Christmas time, chances are it's not going into your savings account or your long-term investing account. And so, yeah, if you haven't watched those, you may want to check it out. Yeah. And I haven't got an example trading plan for this specific trading strategy. But, I do have a number of example trading plans, including one for short call verticals. And this could give you a framework that you can then customize for this shorter term index trading plan. Okay. Okay. So guys, that's really what I had for you today. We placed 2 trades. We did one on the NASDAQ, and then we did one on the Russell. And let's see if that one's filled. And if it hasn't filled, we can always come in here and say, okay, be like that then. If you only want to give us $1.50, whoops, went back up to 155. Let's just make it 150. And we're putting that back in our index option bucket for short verticals. And then we did a trade on the SPX, which we'll cover next week. And we talked about why we picked this time frame. We talked about why this index, and why the delta of 15, and then how we're going to manage it. So somebody's asking, should we look for the highest theta possible? There's a thing with theta. It can look really delicious, right? Because you've got you've got higher premiums, but there's a reason that theta is that high. It's because there's more perceived risk. So when something is coming up on earnings, like if we look at NVIDIA, we've got, really high implied volatility on these, which means your premiums are going to be richer, which makes it look appealing as compared to, say, a Coca-Cola, which, is in the 20s. So, your premiums are going to be a lot lower, but then, this has half the beta, and beta being, perceived volatility, so this is just a much more steady eddy, or at least that's how it's seen. And that's how these options are priced. And so there's no free ride. So you can look for more volatility, or you can take advantage of volatility when it comes your way, or look for ways to take advantage of it, but know that it's a reflection of uncertainty in the marketplace. And so we want to have a plan in place as we go forward, right? Right. So guys, that's a wrap for today. I did a short video yesterday on, if you're looking to invest, what sectors still have strength, and how might you find them and find stocks within it. And I just think it's interesting that I picked Coke because, the strongest sector over the last month and 3 months has been considered to be consumer staples, and Coke is a staple stock, and, it seems to be faring a little better, up 17% year to date than, the major indices. So thanks for hanging with me. Follow us in the land of Twitter, Cameron May, CS, Barb Armstrong, CS. Hit the like button. It helps move this up in the algorithms. And make sure you tune back in next week when I believe Ben will be here. Yeah, the fun in learning will continue. Bye for now.